place in Pennsylvania? This has to be one of the first questions.
The rally continues. Yields lower by a basis point or two. The 10-year 381.20. The lineup for the next hour looks like this. Coming up, we'll catch up with Drew Mattis of MetLife on the global stock sell-off. Mandeep Singh of Bloomberg Intelligence as Nvidia faces an escalating anti ahead of a critical week of U.S. jobs data. We begin with our top story. Stocks coming off the back of the biggest one-day drop since the August 5th rout, as anxiety grows about the state of the U.S. economy going into a slew of jobs data this week, starting with JOLTS this morning and ending with the payrolls report on Friday. Drew Mattis of MetLife joins us now for more. Drew, welcome to the program. Let's start with the credibility of the U.S. economic data. Of the data this week, would you put more weight on some versus others?
Sure. I'd probably put the beige book above JOLTS because we know that one is just kind of what people are feeling. Whereas JOLTS, because of the low response rates and, the potential for revisions, it used to be a data series that only economists paid attention to, and there was a good reason for it. And now that it's kind of gone mainstream, it wasn't quite ready for prime time. And you're having this problem across a slew of data, including in the payroll report we'll get on Friday. So, we have to be really cautious here about overreacting to kind of individual events. I saw kind of the compilation of people talking about the economy before the show started. And Neil Dutta had it right. It's a matter of kind of the direction of travel. The direction of travel is towards a weaker economy. We shouldn't be surprised by this. This is what the Fed wanted to achieve when they took rates higher. The only question we have to ask ourselves now is, how much pain are they willing to tolerate in terms of the unemployment rate moving higher before they actually act? And when they do act, how fast do they act?
Before we talk about monetary policy, Drew, can we just work through payrolls on Friday? How will you navigate that report? Are you ultimately suggesting you'll put more weight on, say, the household survey versus the establishment survey? How will you navigate that report, those reports, on Friday?
Certainly. I'm not going to be actually looking at the payroll numbers. I'm going to be looking at unemployment. It doesn't matter if it's a supply phenomenon or a demand phenomenon. If the unemployment rate's moving higher, people's ability to kind of get higher wages for their work goes down, right? There's more people per job. There's not enough jobs to fill kind of the people who want them. And so you're going to put downward pressure on wages there. So you can just look at unemployment. You keep it simple. You don't have to kind of go into the detail. You can also see how many hours they're working. And how many hours they're working is actually quite important. Even though the economy's been quite strong and there's been a good amount of payroll growth according to the data, if you look at the number of hours they're all being asked to work, what we see is actually weekly wages haven't been keeping up with inflation. And so a lot of Americans who feel like they're falling behind are in fact falling behind. And they're falling behind because even though their average hourly wages are going higher, the number of hours they're being allowed to work is going down. And so in my mind, you want to watch the hours worked, because if that keeps moving lower as it has been, eventually that'll lead to job cuts, because people realize that they can't spread the number of hours of work they have among the existing stock of employees that they have, and they have to reduce the number of employees they have.
Drew, how hard is it to read the jobs reports now, given the fact that a few weeks ago we knew about not just normal revisions, but really massive revisions when it comes to the U.S. job market?
Well, that's why it's important to look at everything holistically, right? You don't want to just look at payrolls. You want to look at what's going on with claims. You want to look at the ISM employment numbers. You want a sense for kind of where the entire economy is going. And you don't really want to fixate or put too much weight on any individual component because of the potential for revisions or data quality issues. Which quite frankly, working as a U.S. economist for a long time, data quality was never an issue before. And post-COVID, data quality is increasingly an issue, and we have to be aware of it and make sure that, we're adapting to kind of a new data quality environment where revisions are larger. That creates the potential for more volatility in markets. We have to not just look at one thing. We have to look at the quality of the data.
If the data quality is not as good as it used to be, do you need to start looking more at what executives are saying, what's in earnings reports? Is that more important?
I mean, earnings reports are a great way to get a sense of things. They're not exactly perfect, because what you find is that sometimes people blame things on the economy, and in reality, it's not the economy, it's them. But I do accelerating from here. The real question is kind of the speed of the deceleration. Are we slamming on the brakes, or are we just tapping them? And if it's tapping versus slamming on the brakes, how fast does the Fed have to move?
Drew, I'd love your thoughts on the next month or so, just the next few weeks. It feels like, from the people we've been speaking to, the bar to go 50 is actually pretty low. I mentioned the view from Citi earlier on this morning that ultimately they think 125 on payrolls, 4.3% on unemployment, which is where we are. They think that's sufficient to go 50. Drew, do you see it the same way? Because when I listen to Fed officials, I don't see them viewing it like that at all. I hear things like methodical, gradual, a reluctance to go big until they see something much more damaging.
I agree with you, Jonathan. I think if they were going to make a large move, they would have gone in July, at the very least, right? So they would have started a slower pace in July. I think perhaps maybe we can all hope that they've learned that if you miss the bus, you can't run after it and try to climb on it while it's moving, because that's what they do with rate hikes, and that's why we're currently seeing the slowing we're seeing and a lot of the dislocations in markets that we're seeing. So, if you miss your window, you can't catch up, right? This is not, kind of, the economy's not that simple. So, 225 basis point cuts over a period of time versus a 50 basis point cut in a single meeting are two very different events, and will have very different effects on where the market will price in, cuts over the next year, right? If you ratify market expectations of 50 now, that's going to price in, it's going to ratify market expectations across the next year or so. Whereas if you go to 25 and you say, look, we're calibrating here, then the market will have a very different response, and maybe one that will allow you to actually maybe eke out a few more cuts and get policy down to a point that's a little more, in line with the sustainable growth in the economy.
You and Neil are very much on the same page. Drew, thank you, sir. Drew Manis there of MetLife. Looking ahead to the economic data this week, raising questions about the credibility of some of these reports, and ultimately making a forecast on what the Fed will or won't do come September 18th. Equity futures right now on the S&P negative by 0.4%. The pullback continues, just not as vicious as it was yesterday. Let's take the opportunity to get you an update on news elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Well, the pullback in oil is not continuing this morning. It is higher by about 1% for NYMEX crude. It sank 4.3% yesterday to its lowest level of the year. There's downbeat economic data from China and the U.S. that fueled demand fears. Meanwhile, on the supply side of things, a Libyan official said it was closer to a deal that would restore the country's crude flows. Following that drop yesterday, OPEC Plus is now discussing a possible delay to an oil output increase that had been planned for October. That, according to officials involved in the talks. BYD is putting plans to announce a major planned investment in Mexico on hold. According to people familiar with the matter, China's top EV maker won't make a decision until after the U.S. election. BYD was scouting 3 locations for car production facilities in Mexico, but has stopped actively looking for now. U.S. political uncertainty also led Tesla to delay plans for a factory in Mexico. And shares of Dollar Tree plunging nearly 12% in the pre-market trade. The discount retailer reported second quarter earnings that fell well short of estimates. The company also forecasted full-year net sales below prior forecasts. The company's CEO saying, quote, "We are encouraged by the continuous progress we are making, despite immense pressures from a challenging macro environment." That's your brief. John.
Some of the reports, the language coming out of the discount retailers, really not good over the last few weeks. Danny, thank you. Up next on this program, the Beltway versus Big Tech.
I just view this as more of a scarier headline than the reality. And also in the context of what's happening in Big Tech, NVIDIA is just part of the club that continues to be part of that pressure. Beltway versus Big Tech.
That conversation up next, live from New York this morning. Good morning.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
It's from super hot to solid.
This is normal.
I think people underestimate the behavioral aspects when it comes to the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
So what is bad on September 6th?
Nobody really has a full answer on it.
I don't know what counts as good news these days.
It's a big debate.
The August Jobs Report, Friday on Bloomberg.
Let's start with a snapshot of the price action, and then we can look at one single name. Cross asset, things are shaping up as follows. Futures, negative 0.5%. Bonds, still rallying. That risk aversion continues, down 2 basis points on a 10-year, 381. Let's talk about a single name together. Dollar Tree, cutting its outlook on muted consumer spending. Danny brought this stock up just moments ago. We're down by more than 12%. Think about what we heard from Dollar General in the last CEO. This was the CEO from the last week or so. This was the CEO a week ago. Inflation has continued to negatively impact these households, with more than 60% claiming they have had to sacrifice on purchasing basic necessities. A shocking headline coming out of that name in the last week on low-income shoppers. And you see it again this morning, Dollar Tree down by 12%.
The issue is a lot of these stores actually were the ones that were able to do well in times of economic stress for especially individuals in lower income scale. The issue is the competition right now that they're seeing from places like Aldi coming into the United States and Walmart.
It's a big struggle. That name is down by more than 12% in the pre-market. More still to come on that conversation. Under surveillance this morning, the Beltway versus Big Tech.
I just view this as more of a scarier headline than the reality. Also, in the context of what's happened in big tech, NVIDIA is just part of the club that continues to be part of that pressure, Beltway versus big tech. We're not too concerned about this for NVIDIA. I think just because when you actually look at what's happened here from an execution, the reason that they've essentially dominated it is just because how stellar the execution has been and how they've just been so far ahead.
So here's the latest. NVIDIA suffering a record $279 billion rout, the biggest loss of value ever for a US stock on the back of renewed AI worries. This as the DOJ slams the chip maker with an antitrust-related subpoena over its marketplace domination. Joining us now to discuss is Bloomberg's Mandeep Singh. Mandeep, good morning.
Morning.
Simple question, maybe complex to answer, but what have they done wrong?
Well, so in this case, what DOJ is investigating is how have they distributed their chips to their customers. And anytime you have, a virtual monopoly, in this case, NVIDIA has over 80% market share in the GPU business. In an undersupplied market, how are they distributing the chips comes into question. And I think some of the focus is simply because their largest customers are the hyperscalers. So NVIDIA could potentially tell them to buy more. Otherwise, they can pull back, the allocation they have to a certain hyperscaler. So things like that, there's nothing clear, but NVIDIA is clearly trying to go up the stack. They've also made an acquisition that may come into focus as well. The deal hasn't closed. It's a small company called Run AI. But potentially, they may have to make some remedies. I still don't think there's anything big here.
Let's separate the purchase just for a moment. I just want to explore the supply. What are the alternatives? Where else would they go if they couldn't go to NVIDIA?
And that's the thing, right? So potentially customers could go to an AMD. AMD has a small GPU business, but in this case, there's a clear preference in the market for NVIDIA's chips, and those are more undersupplied than any other chips. So the question is, how is NVIDIA deciding who are the customers who should be getting the allocation? So if they, let's say, make 20 million chips in a year, how are those getting distributed? And I think that's where the question comes into play, whether SMCI Did they overbuy NVIDIA chips? Did NVIDIA ask them to overbuy those chips? So that, I think, again, nothing is clear, but because the market is so undersupplied, the question is natural, that how is NVIDIA working with its customers that's a concentrated base?
A lot of criticism has been NVIDIA's moat strategy. Can you actually explain what that entails?
Well, so, I mean, look, NVIDIA clearly has the IP when it comes to these GPUs. They also, for the next quarter, according to historical standards, but still, I mean, the ramp of the data center business has been nothing short of phenomenal.
So the DOJ is going after NVIDIA. Customers want NVIDIA chips, but Intel seems to be somewhat backed by the U.S. government. $20 billion grant. What's going on there?
Well, so that grant was more on the fab side. I mean, look, when it comes to chip design, I think Intel can make those chips and go to TSMC to have those manufactured, since they don't have the manufacturing capacity here. But what the US government is giving them subsidies for is really to build the fabs here. And we know those will take time. That's where Intel still has to prove that their execution is working. But I think those are two separate things. NVIDIA is obviously a fabless vendor. It outsources all the production to TSMC, and everyone in the GPU space right now is going to TSMC to have their chips manufactured.
Before we saw, though, the DOJ news come out yesterday, the stock was already falling. What do you think was really the catalyst for that? What was driving this?
I mean, valuation. We talked about it during earnings. Like, you really need to see the estimates keep going higher. If the estimates are going sideways, that's not enough to sustain these kind of valuation multiples. NVIDIA was trading at over 35 times forward PE. At those kind of valuations, you better see your estimates keep going high. And the way they guided, it was a little conservative on the Blackwell side, the delays, and now there's antitrust. All these are incremental factors that will just prevent people from raising their estimates.
What does this volatility remind you of on this single name? Have you ever seen a stock move like this, a stock this size move like this, $270, $280 billion of market cap in a single day?
No, because the way NVIDIA has grown, its market cap has been nothing short of phenomenal. Like the way they came from 1 trillion to 3 trillion, there wasn't a lot of time in between. And that's why, you know, with these 1-2 day moves, they're sharp moves, but then in the grand scheme of things, it's still not that big. You know, yes, it's a $3 trillion market cap company. You would expect it to be more stable like a Microsoft or an Apple, and you don't want to see that, but it's not recurring revenue. And that's the biggest risk for NVIDIA, that this is not a recurring revenue business, although some would argue that you have to refresh your chips every year, you have to upgrade your data centers, so it will become a recurring revenue business over time.
Does that make you nervous?
Absolutely. I mean, that's the big risk, that even if NVIDIA executes phenomenally well from here, the valuation multiple may still compress, because what's priced in right now is that 50% plus growth going forward. I mean, everyone expects this year they will grow, they'll double their data center revenue. What about going forward? What is the free cash flow profile? The gross margin risk. Everyone talked about how the gross margin has peaked for NVIDIA, and for a good reason. They had some Blackwell delays. They need the distribution. And so if the gross margins are compressing, estimates aren't going up, the stock cannot keep expanding multiple.
You've flagged this for a while. Mandeep Singh of Bloomberg Intelligence. NVIDIA is down by almost 2%. Coming up next on this programme, we'll catch up with Ron Dermer, the Israel Minister of Strategic Affairs. That conversation up next.
lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Quite an eventful start to the month of September, that's for sure. Equities down across the board. We're negative 0.4 on the S&P. We're down by 0.7 on the Nasdaq, down by 0.4 on the Russell. An eventful start that looked like this in yesterday's session. On the S&P, the worst day since August 5th. On the Nasdaq 100, the worst day since July 24th. Late July and early August, a messy period for this market. Are we looking at red needle in the last day or so? If you missed the big rally, it's going to be a little dangerous to chase it now. We are playing with the probability of the job market stabilizing here or deteriorating fast. That's the debate for the rest of the year, and certainly that's the debate right now going into payrolls. Switch up the board and turn the page. I want to talk about the commodity market and what's happening in crude. Crude bouncing after yesterday's losses on Brent and WTI. We're up by 0.6%. We were up by more than 1%. News story out in the last couple of hours. AMH signaling that maybe OPEC is backing away from its supply decision later this year.
Right, they're maybe going to add some more barrels to the market later this year in the fall. Doesn't look like they might do that now. You saw prices yesterday really have a little bit of a scare. Part of that has to do with these concerns coming out of China, but also, especially OPEC wanting to potentially make this U-turn, has to do with the fact that we might see more barrels come from Libya. So if Libyan oil barrels get to the market, there's really no need for OPEC to bring barrels to the market, especially if they want to keep, Jonathan, a floor under this moral market, the price.
That's the latest on crude. Under surveillance this morning, let's get to some top stories for you. Kamala Harris set to propose a $50,000 tax benefit to boost new small businesses, increasing the current deduction tenfold. Harris setting the lofty goal of 25 million new small business applications in her first term if she's elected. It's another effort to try and signal that they're still going to be the party for corporate America at a time when we're not sure which party is what.
And it looks like they feel this administration, what we saw recently from Joe Biden, but also on the campaign trail from Kamala Harris, she's trying to feel like she can move towards the center. They have the progressives at the moment potentially lined up behind them. She wants to go out and say, we are for big business. But this all comes down to small businesses. But this all comes down to the tax fight for 2025. And you're going to hear a lot of people almost feel like they're throwing policy spaghetti at the wall and seeing what sticks. But this is all going to happen depending on the composition of Congress. Also, we should note, they come out with things, the Harris campaign, talking about price gouging. Then you have an economic policy advisor to Kamala Harris, Mike Pyle, come on this program, walk it back, saying this is just about regulation. We don't think it's grocers' fault. But then what do you see in the last 24 hours? Ads over swing states saying it is corporate greed, they're driving up your costs, and that is the responsibility for this greedflation.
Let's focus on one swing state. Let's focus on Pennsylvania and this story right here and how difficult it's going to be to navigate this in the months to come. The U.S. Steel CEO, David Burritt, telling the Wall Street Journal the company will likely close steel mills and move its headquarters out of Pittsburgh if a sale to Nippon Steel collapses. Both presidential nominees, and we know this from campaigning over the last 24 hours alone, Kamala Harris and Donald Trump coming out against the deal, the topic raising questions and tensions in the crucial swing state of, drum roll, Pennsylvania.
So with this new information, I want to know whether or not we're going to see a reversal, like we have seen from politicians, regarding this transaction. Donald Trump is going to be giving an economic speech here in New York tomorrow. Will he talk about this? Also, Jonathan, I know this is reporting in the Wall Street Journal, but the editorial board this morning scathing on both of these campaigns. They say a sign of the rotten political times that President Biden, Kamala Harris, Donald Trump, and J.D. Vance all agree on the dumbest economic idea of the presidential campaign so far, opposing this acquisition. They say because this is the money needed to make sure that you have a robust steel industry and a growing U.S. steel in Pennsylvania.
That's the latest on Pennsylvania. Let's get to the latest on the Middle East this morning. The Justice Department charging 6 senior Hamas leaders with terrorism and conspiracy to kill Americans days after 6 hostages were killed in Gaza. The charges including counselling to the group's October 7th assault on Israel, as well as a string of other attacks going back more than a decade. The Attorney General Merrick Garland citing the death of a 23-year-old Israeli-American in his statement. Joining us now to discuss the state of this war and the future is Ron Dermer, Israel's Minister of Strategic Affairs. Minister, welcome back to the programme, sir. I think we're all very, very focused on where we are in truce talks, and we'd like to start the conversation there, if we can. This came out from the Times of Israel, just reporting just moments ago that the Prime Minister, Netanyahu, sent the Mossad chief to Doha to inform the Qatari PM that Israel is still prepared to fully withdraw from the corridor between Egypt and Gaza in a deal's second phase. Can you confirm this morning for us, Minister, whether that reporting is accurate or not?
No, I think just to explain to your viewers what we're talking about, because there's been so much misreporting and half reporting. Understand that Israel currently occupies this corridor, which is between Egypt and Gaza. And that corridor, when it was left open and when Israeli forces were not there, was used as a supply route for all of the arms coming into Gaza. That's how they got armed. Their other borders actually are with Israel. And so the arms did not come from Israel. They came through that border. And Israel took over the Philadelphia corridor in the last 2 or 3 months, and also the Rafah crossing. And that has blocked all the arms and weapons from going into Hamas. The deal that is proposed on the table, phase 1 of that deal, Israel has made clear, and the Prime Minister made clear in a televised press conference a couple days ago, and I'm sure he'll speak to the foreign press soon as well, that Israel's not going to withdraw from that line. We won't withdraw off that corridor, because if we do that, then you're going to see those weapons come back. Phase 1 of this deal, what it calls for, Jonathan, is to have negotiations over the conditions over a permanent ceasefire. And once you've concluded those negotiations, while you're in a ceasefire for phase 1, in order to get to phase 2 and a permanent ceasefire, that's when you can discuss long-term security arrangements on the Philadelphia corridor. So I think that report is a little bit misleading, thinking that in a few weeks Israel is going to leave. But it is true that Israel is committed to actually negotiating this deal. We've been committed from the beginning. When the president put forward a proposal based on a May 27th document, he put forward a proposal and a speech at the end of May. Israel said yes, Hamas said no. Then the U.S. put forward a final bridging proposal, which they called it a final bridging proposal, in the middle of August. We said yes, Hamas said no. Hamas has not been interested in moving ahead to close the deal. They were interested, frankly, Jonathan, for the last several weeks, in an escalation in the region. They wanted Hezbollah to attack Israel. They wanted Iran to attack Israel. And I think now they're hoping that somehow Israel's government will make compromise that it wasn't prepared to make it before. And I can assure you, Jonathan, in the wake of the horrific execution of 6 hostages, including an American, Hersh Goldberg, Poland, Israel is not going to make concessions in the wake of that. We are committed to a deal. We set people to sit with negotiators to try to get that deal done. And I hope we can do it. We're working with the U.S. administration to try to push that deal forward.
Minister, as you know, we're very focused on accuracy here at Bloomberg. So you said that report was slightly misleading. Can we just reconfirm the aspect of it that was misleading? And could you confirm whether in a second phase, Netanyahu has ultimately sent the Mossad chief to Doha to inform the Qatari PM that in a second phase you are willing to fully withdraw from that corridor?
We don't. I cannot talk about the arrangements in a second phase because we haven't even negotiated about it. Who is going to be there? How long is it going to take? I'll make it very simple for you, Jonathan. Until we have an actual practical solution on the ground for the Philadelphia corridor, Israel forces cannot leave. And for the last 20 years, we haven't had that. We had Egyptian presidents, and they announced that their policy was to stop the smuggling that would go into Gaza. We had that in Mubarak. We have that in Sisi today. What happened on the ground was a different matter. When Morsi was the president, you remember from the Muslim Brotherhood, was the president of Egypt, A highway of weapons came into Gaza. So the question is not necessarily Egyptian policy at the top levels. It's what's happening on the ground. What are you going to do on the ground to prevent that border from being a porous supply route for weapons to Hamas? Because we have
Minister,
to
it
avoid
raises an obvious question, if I may jump in, sir, and just interject, because I'd love some clarity from you on this. Minister, I just want to squeeze this in and then you can complete your thoughts, sir, just quickly. If you can trust Egypt to mediate the talks, why can't you trust them to secure the border? Isn't that a contradiction that we need to try and reconcile?
No, I don't think so. By the way, Qatar is also a mediator of the talks, and Qatar has been harboring and financing Hamas for a long time, and frankly, financing the Muslim Brotherhood all over the world, and also promoting a lot of Hamas propaganda, which is anti-Semitic, anti-American, through their state-controlled television station, Al Jazeera. So I don't think those two are necessarily go hand in hand. The fact is, for the last 20 years, since Israel left in the disengagement, a move that was applauded by the whole world, we left that corridor called the Philadelphia Corridor. We left the border between Egypt and Gaza. We have not had a solution on the ground. I'm not questioning the intentions of the Egyptians. I'm questioning the results. And all of Israel saw it. October 7th could not have happened without that border being open. And so Israel now has closed that. And until we have an actual practical solution on the ground that is working after 20 years of failure, Israel can't leave that line.
Minister, I need to follow up on one other aspect of this, and that's the division that might be emerging in the Israeli government. There was another report, and by all means, if this didn't happen, you can tell me it didn't happen, that your defense minister told the Security Cabinet the following, quote, "The fact that we prioritize this corridor at the cost of the lives of the hostages is a moral disgrace." So how do you respond to that voice coming from within your own government?
Yeah, I'm not going to get into private conversations. The Security Cabinet, I will just tell you that the Security Cabinet, of which I am a member, there are 10 of us in that cabinet. 8 of us voted to support the Prime Minister's position. 1 of us voted to abstain, and 1 voted to oppose. And he made a very clear position that Israel was not going to leave that corridor. And that is a position, by the way, Jonathan, that is, in my view, supported by the overwhelming majority of the Israeli people. I believe it is wrong to say it's either staying in the corridor or saving the hostages. It's not true. There are many other aspects to this deal that haven't been resolved. The United States is working diligently to try to resolve it with the other mediators and with us. Hopefully we can get there. But it is clear that in phase 1, Israel will stay on that line until we have a practical solution on the ground that we can convince the people of Israel will know that what happened on October 7th will not happen again, that Hamas will not be rearmed. They will not have an opportunity to do again and again October 7th, which is what they're saying. That's what they're saying today, Jonathan. That's what they intend to do. We've cut off the supply lines of weapons. We're not going to open that supply line without having a solution on the ground that works.
Minister, can we go back to this phase 1 agreement? A few weeks ago, Secretary Blinken was in Israel, and he said there was a very constructive meeting he had with Netanyahu and confirmed that Israel supports that bridging proposal. Then just this week, President Biden said Netanyahu was not doing enough. How do you manage what's coming out of the United States? What exactly does the U.S. want to see from Israel, and why is Israel not complying?
Well, I think that just the facts are, Anne-Marie, as I said, there was a proposal put forward in May. Israel said yes. Hamas wasn't interested in talks. They added so many changes, around 24 changes to that proposal. Then there was another bridging proposal in August, which was the one that Secretary of State Blinken was referring to. I was in his meeting with the Prime Minister, and it was a very constructive meeting. And Hamas said no to that. And the reason why Hamas said no at that time to any offer on the table is they wanted Hezbollah and Iran to attack us and to create a regional war. That's what they wanted to do on October 7th, and they wanted to do it in the last several weeks. My hope would be, hopefully, that the potential of a regional escalation is in our rearview mirror, and we can get down and see if we can finish these talks. What the last thing that Israel is going to do is, in the wake of the execution of 6 hostages, is to make concessions that it would not have made before. That is not going to happen. In fact, all the Israeli Security Cabinet was united that Hamas is going to pay a heavy price for that decision. Because if we don't do that, not only is it going to be dangerous for get to a hostage deal, they're going to start killing hostages, thinking that if you kill hostages, you get concessions. We're trying to get as much as we can on the same page of the Americans. I think we've been there for the last couple months. Hopefully we'll continue. And I think when the U.S. and Israel show no daylight between them, And when all the pressure is directed where it should be, on Hamas, I think the chances of getting to a deal go way, way up. And I hope we can get there in the next couple of weeks.
Is it your understanding that right now what the U.S. is putting on the table in these discussions, in these conversations, is, quote, take it or leave it?
Well, I don't know. The bridging proposal that was put forward on August 16th was a final bridging proposal. So I don't know if this will be a final bridging proposal, and then we'll get a final bridging proposal. It might be that they're talking about specifics and details, because this is a kind of framework agreement, and there's still a lot of things to be negotiated. Again, the problem in the negotiation is not just the Philadelphia Accord. There are several things, maybe a half dozen things that have to be closed in order to get to a deal. Right now, we have not seen, and I want to repeat this again, at no point has Hamas agreed to any deal that's on the table. They have rejected everything. We had one movement of Hamas, which was in early July, where they understood that there's not going to be an end of the war as an entry ticket into a deal. There will be a temporary ceasefire of 6 weeks. And then during that temporary ceasefire, we're going to have to negotiate what would be the conditions of a permanent ceasefire. The Philadelphia Corridor and how you block weapons from going into Gaza is an important part of that. We're willing to negotiate all of that, and we're willing to get into that first stage of the deal. Hamas made that change. I don't know if they still actually agree to that. But on the other issues, there are still pretty significant gaps that have to be closed, and the U.S. is trying to do that. I will tell you that the Justice Department's decision yesterday was a very good decision to put pressure on Hamas. Hopefully, the other people internationally and regionally will put as much pressure on Hamas as possible, because Israel's government wants to get to a deal. Believe me, Israel's government wants to get to a deal. What we're not willing to do is go to a deal that's going to endanger the security of 10 million Israelis. But we're willing to do a deal, and we hope we can get there as soon as possible.
Minister, you're saying you want to get to a deal, but just this morning, your National Security Minister, Ben-Gvir, came out on Twitter and said, quote, I'm acting to halt negotiations with Hamas. So is that not accurate?
That's not the position of the government of Israel or the Prime Minister of Israel. As I've told you, we have different views of different government ministers, and the Prime Minister encourages people to say exactly what they think in all these meetings, but then you come to a vote. And the Prime Minister's position, which is we're willing to get to a deal, we want to get to a deal, we have red lines that we have to keep, but we want to get to that deal to bring those hostages back. Up until this point, we remember on October 7th, there were 250 hostages that were taken. We have succeeded in bringing 150 hostages back. 110 of them or so have been alive. And I tell you, the murder, the execution of these 6 hostages was gut-wrenching for all the people of Israel, no matter where they are on the political spectrum. You probably may have had them on the show, the Rachel and John Goldberg, Poland, what they have done in raising awareness about the plight of the hostages and their dignified struggle and heroic struggle really for their release. It was a major, major blow. And a lot of Israelis are angry, and I can understand that. I think that the anger has to be directed against Hamas in order for us to get to a deal. And yes, there will be people who will vote against the deal. I believe some of my colleagues in the government will vote against the deal. But the overwhelming majority of the country and also of the government backs the Prime Minister's position and wants to get to a deal.
Minister, you've been very generous with your time. Before we let you go, just a quick question. Will the Prime Minister be attending the UN General Assembly later this month in New York?
I believe he will, but, you know, with what happens in our region in the Middle East, you never know. I think he intends to go there, and hopefully we can make that happen. And he'll have a chance, just as he addressed the American people in the Congress a couple of months ago, he'll have a chance to address the world about how we move forward in this region and how we can move from this catastrophe that happened on October 7th to move towards a different future for Israelis, for Palestinians, and for everyone in the region.
Please let the Prime Minister know we would love the opportunity to sit down with him later on this month, sir. Minister, thank you very much for your time. Ron Dermer there, the Israel Minister of Strategic Affairs. Let's give an update on stories elsewhere, just briefly, with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs economists are cautioning that the U.S. GDP will take a hit in the second Trump presidency. The researchers, led by Alec Phillips, wrote, quote, the hit to growth from tariffs and tighter immigration policy would outweigh the positive fiscal impulse. Should VP Harris win with a Democratic sweep, Goldman said there would be a slight boost to GDP growth thanks to new spending and expanded middle-income tax credits, slightly offsetting the impact of higher corporate tax rates. Elon Musk's internet provider Starlink is reversing course, saying it will comply with Brazil's top court order to block the nation's access to X, formerly known as Twitter. The change follows a judicial order which froze Starlink's bank accounts. And the demand hit to aspirational luxury is forcing Swiss watchmakers to turn to the government for financial aid. Girard Perregaux and Ulysse Nardin are the first brands to confirm that they're using the state assistance. SOWIN Group CEO, which owns those manufacturers, called it a, quote, small watch crisis. Under the government program, the Swiss state pays up to 80% of the workers' salaries. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, looking for a soft landing.
The fact that core inflation is running below 2%, to me, that suggests that they're already too tight. So going 50 on the first go is not a particularly big risk.
That conversation up next. You're watching Bloomberg TV.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product. It's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Stocks lower, bonds rallying, yields down by 2 basis points. The 10-year 381.39 under surveillance this morning, looking for a soft landing.
The fact that core inflation is running below 2%, frankly, if you look at it since last summer, we've been below 2% annualized on a monthly basis most of the time, believe it or not. To me, that suggests that they're already too tight. So going 50 on the first go is not a particularly big risk.
Here's the latest this morning. Treasury yields extending declines after yesterday's soft ISM manufacturing print. Traders bracing for more volatility with fresh data ahead, including jolts at 10 a.m. Eastern Time. Roger Hallam of Vanguard writing the following: we think the pricing of near-term rate cuts is a little too aggressive. However, we acknowledge that the bar for a more rapid pace of easing, should further labour market softening become evident, is low. Roger joins us now for more. So, Roger, with that quote, and welcome to the programme, sir, just how difficult is it to invest in this moment, given the risk to either side in either direction?
Yeah, I think when you look at the trend in data we received last week, the economy still has what I would say is pretty reasonable momentum. GDP growing at 3% in the second quarter. The July spending data still suggesting the consumer has significant momentum. But then policy is in restrictive territory, and when we look forward into next year, we do see the economy is likely to slow, potentially approaching what we'll term stall speed around the middle of the year. So, Growth looks good now, but we do see slowing going forwards. I think the Federal Reserve acknowledges that as well. That's why they're set to start to ease at their September meeting. As I said in the quote, we think that the most likely scenario is the Fed starts to ease in a 25 per basis point clip, so 75 bips of easing this year. But we must acknowledge that with inflation now close to target and the labour market much looser than it was, those risks of a more proactive Fed easing stance, I think, is reasonable.
Roger, just how low is the bar to go 50? You mentioned the bar's low to ease even more. How low is it? What numbers are we talking about on Friday? And does it just come down to that one print?
I think it doesn't just come down to that one print, but I think, to answer the question, I think if we saw job gains below 100,000 or a further tick up in the unemployment rate, I think that the case for 50 would be reasonably high. Real policy rates north of 3%, and with inflation back at trend and a labour market that has come back into better balance, real policy rates of above 3% looks like the policy's in the wrong place. So the Fed is right to get started. And if the risks are increasing that we could see a more material slowdown in growth or the labour market, I think the Fed can easily get more aggressive this year. And I think that, as I say, the bar to that, I think it is very low.
When we begin to think about normal, what kind of numbers do you associate with normal, both for the incoming data in the payrolls report and for ultimately the destination for interest rates in this country?
Yeah, you look at the Fed's long-term neutral dot, we're in that 275 type region. We actually think the neutral rate is a bit higher than that, somewhere between 3 and 3.5. So that 200 basis points of easing we have over the next 8 meetings takes policy towards where we would think around that neutral level. Now, in a more adverse economic outcomes, that trough in the policy rate of 3% we think can still fall materially further. Typically in more recessionary type episodes, the Fed takes the real Fed funds rate negative. So down to 3.5 would be neutral, but in more adverse economic outcomes, rates can still fall materially further than that.
Roger, your base case, 3 cuts this year, more cuts on the way next year. How do you consider cuts next year, even though we might have higher inflation, higher tariffs, very difficult to game out?
Yeah, I think the policy outlook for next year becomes a lot more uncertain. If you think that, say, real policy rates at 3%, I think it's going to be difficult for the Fed to avoid contemplating going 50 at some point over the next year if we do get some growth wobbles. And obviously we get the ups and downs in growth. It seems likely we will get a period over the next year where we do get a trend of weaker data. And the Fed at that point will have to make a serious decision as to whether the risk-reward of actually picking up the pace of easing is favourable. And we saw that in prior easing cycles, that if in downside economic developments, the bar for the Fed picking up the pace of easing, delivering more than the market's priced in, that is a typical outcome for a Fed easing cycle.
Roger Hannam of Vanguard. Roger, appreciate your view. Thank you, sir. On the bond market, going into the jobs report this coming Friday, the estimate in our survey still in at around 160. If you want to see the price action, currently equity futures still pulling back by 0.4%, following the biggest one-day loss, going all the way back to August 5th, which was not a great time for this market. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Laurie Heinel of State Street, the co-CEOs of On Holding, Martin Hoffman and Mark Mora, and Amanda Lynham of BlackRock. More on that and a whole lot more from New York. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. When I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There's a lot of opportunity for those who want to do their homework and look in the equity market.
I think there's opportunities in things that aren't so obvious to people because they are more economically sensitive.
The income side of the economy is what has me most concerned. It's not a reason to panic, but it's a reason to understand why consumers are going to be more prudent.
The outlook for retail for the rest of 2024 may not be so strong.
Subsurface activity down the cap spectrum, you have started to see more improvement. And I think that's a healthy thing for the market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, the third hour of Bloomberg Surveillance starts right now. Let's kick it off with the scores on the S&P 500, negative by 0.4%. On the Nasdaq, we're down by 0.7. On the Russell, the small caps off by 0.5. Adding to yesterday's losses, the S&P 500 with its biggest one-day drop since August 5th. On the Nasdaq 100, its biggest one-day drop since July 24th. The week ahead, been through this a few times. Here it is again. It concludes with payrolls Friday. The median estimate in our survey, around 160,000 jobs for the month of August. Later on today, we get the job openings data. That comes at 10 a.m. Eastern Time. Durable goods and the Fed's beige book a little later on this afternoon. More signs of consumer weakness earlier on today. This time it's Dollar Tree cutting the outlook. Consumer difficulties, the stock getting absolutely hammered. And Anne-Marie, we saw exactly the same thing with Dollar General about a week ago.
Yeah, it's showing that this consumer is struggling to maintain higher inflation, higher interest rates. What's also interesting is that these stores are the ones that are supposed to do well in this environment. And why aren't they? Look at the mass competition that's come in from places like Walmart that actually says the higher end consumer is trading down. Places like Aldi, they're offering their price cutting, and they are a real competitor now. And that's clearly weighing on these companies.
I mentioned this quote from Dollar General a few times in the last week, mentioned it in the previous hour as well. I think it's worth going over again. Dollar Tree with its own difficulties down 11%, but certainly seeing the same story. Dollar General in the last week, in what I think was maybe the quote of August from corporate America on low-income shoppers, inflation has continued to negatively impact these households, with more than 60% claiming they've had to sacrifice on purchasing basic necessities. When we talk about the inflation story being mission accomplished potentially at the Federal Reserve, for Main Street America, it's anything but. And you can see it in these numbers repeatedly.
This is what Raphael Bostic continues to say. We're getting closer to our target. Potentially we're not there. His concern has always been cutting and then seeing they didn't kill the inflation dragon, then they need to hike again. He doesn't want to do this whipsaw, which is why it's interesting when people come on and say, potentially we'll get 50. How do you get someone like Raphael Bostic to 50 when he still has concerns about some of this inflationary pressures?
Still using the words like gradual and methodical on repeat. Equities right now on the S&P 500 negative then by 0.4. Just to touch base with the bond market, the rally continues. Yields are lower once again on a 10-year down to 381. We're down about 2 basis points on the session. The euro not doing much. Euro dollar 110.49. Crude bouncing by 0.8%, $70.88. Brent crude rallying as well. Just a story that dropped in the last few hours. A conversation now around whether OPEC has to pull back on this increase in supply that was due to happen later this year.
Because they probably want to protect prices, and also they now are going to have potentially a deal in place with the Western and Eastern governments of Libya. Means more Libyan market oil will come to market. So why does OPEC have to add? Also, they are basically fighting the United States. They are fighting more than 13 million barrels a day from the U.S. This is something that they didn't always have to contend with.
Brent crude 74.14. Coming up this hour, here's your lineup. Laurie Heinel of State Street as the global tech sell-off continues. Lisa is at the Goldman Sachs Retail Conference. She'll be catching up with the on-holding co-CEOs Martin Hoffman and Mark Mora as the footwear brand ramps up international expansion, and Walmart Senior VP Manish Juneja on a new e-commerce lineup. All of that still to come through the next 55 minutes or so. Let's kick it off with our top story. Another month begins with another sell-off. Stocks posting their worst day since the early August meltdown as traders brace for more US data. Laurie Heinel of State Street writing, in the US, economic activity has proven resilient, but we're seeing meaningful signs of a slowdown. More focus is on the labour market now, and we're watching for signs that would indicate more concerning deterioration. Laurie joins us now for more. Laurie, welcome back to the programme. Let's start with your quote. Meaningful signs of a slowdown. Where do you see those signs currently?
Well, certainly we saw some of that in the labor market reports, and the underlying weakness that we're seeing come through there is certainly something that's been concerning. But we've been on the hunt for a while for the Fed to get started with its rate cutting. We actually think that rates at the current levels are too restrictive, given the slowdown in activity that we have seen this year.
Are you leaning back out then of US equities? What are you doing with your exposure to US stocks?
Yeah, so we have definitely paired our exposure to stocks overall, not just in the US, but if you look outside the US, China has been slowing. Eurozone looks really challenged at this point in time. So we do maintain a slight overweight to equities versus where we were earlier this year, but it's much more concentrated in large cap US in particular, with a little bit of fringe exposure in EM where we think valuations look pretty attractive.
Laurie, where is the rest of the world right now? We're having this big conversation around the story at the Federal Reserve. Will interest rates normalise? At the same time, we're trying to work out whether growth differentials can rebalance as well, because growth differentials have been very, very wide, as you know. US great, Europe struggled, China struggles. Do you think we can close the gap in the months to come, or do Europe and China have their own difficulties?
Well, it's very idiosyncratic. I mean, certainly in Europe, they've already started to cut rates, and we think there's room for them to cut further there. The problem there is that you have a lot more pressure from the geopolitical risks that are burdening Europe. You also have a little bit mix in the sectors, which is not flattering. So some of the more pro-cyclical kinds of sectors are more well represented in Europe. So that's an area that we've been quite cautious on, despite the fact that it looks relatively attractive. And then you look at the US, and there are still lots of tailwinds. So we think the consumer is a bit challenged, as we've talked about, but there are places like government spending continues to prop up some of the US markets. And you do still have a lot of the key industries and technology that are dominant here in the US.
Laurie, when you say the consumer is challenged, do you mean across the board, or are you really just seeing this in the lower end?
Well, it's primarily in the lower end at this point in time. And of course, we've seen things like stock market valuations and housing increases really benefit disproportionately at the upper end. But some of the things that are starting to concern us are broader scale layoffs. We're starting to see announcements of companies that are employing, largely white collar, relatively higher compensated employees. That's an area that we're going to be watching very carefully, because at this point in time, that upper end is not challenged, but that doesn't mean it couldn't become so.
We know that the Fed is now focused on the labor portion of their dual mandate. You say why we believe a 50 basis point cut is warranted by the underlying health of the economy. Explain those reasons. We think the Fed is more likely to cut 25 basis points. What do you think they need to see Friday to move to 50?
Well, I think there's very little that could move them to 50 in September, despite the fact that we think that that's warranted. They've been signaling all along that they're going to be very data dependent. They've been signaling all along that they're going to be measured. They definitely have the inflation boogeyman in their sights still. So I think it's more likely that what we'll see is a 25 basis point cut, but a bit more forward guidance around how they're seeing this evolve and what might cause them to actually get more aggressive.
When it comes to the data on Friday, when you look at it, do you take it with a grain of salt, given the massive revisions we recently saw?
Well, that's been the big story that we've been talking about all year that I think is starting to finally get a little bit more attention. The fact that at the time when central bankers are focused so much on the coincident data, that data has been very volatile and subject to lots of revisions. And we saw that in the labor reports that came out that actually led to market weakness in August. So it is a sort of a conundrum for them right now, but they have committed to that, and we think they're going to stick with that. But they will look through that. And I think the fact that they're broadening out to look at things like the labor markets instead of, or just not just inflation, is very healthy from that standpoint.
Laurie, it's difficult. We've asked this question a few times already this week, whether we should just ignore headline payrolls on Friday or just subtract 60 to 70,000. I even had a question yesterday, and I'd love your thoughts on this too, whether we should place more weight on the ADP, because maybe the ADP report gives us a better read of things. We had a guest earlier this morning that said ignore jobs, job openings, focus on the beige book later on this afternoon. Laurie, how much weight do you put on one report versus the other this week?
Well, we actually would agree with you completely. You have to look much more broadly because it's not even just the headline number, but what's underneath the surface. What are we seeing in terms of hours worked, for example? We're also hearing more and more that employees are getting a little bit of pricing power, that they don't have to necessarily pay up to get that incremental employee. So it's not just about the headline number, but look at the detail, see what else is out there, where there might actually be weakness that the Fed will be responsive to.
Laurie, thank you. Big week ahead. Laurie Heinel there of State Street on the latest. Let's get you an update on stories elsewhere with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Volvo Cars is walking back its target to go fully electric by 2030. It's just the latest manufacturer to rein in its EV ambitions on waning demand. Instead, Volvo will aim for 90 to 100% of its sales to be a mix of both fully electric and hybrid cars by the end of the decade. The company said it still plans to become a fully electric car company longer term. Dick's Sporting Goods delivered better than estimated second quarter results and raised its full-year forecast for sales and earnings, still falling 1.3% in the pre-market. The report does suggest the sporting goods store is sidestepping widespread consumer caution that hurt other company chains. The company expects comparable store sales, a key retail metric, to rise 2.5% to 3.5% in 2024. That is up from a previous forecast that topped out at a 3% gain. NVIDIA CEO Jensen Huang's wealth tumbled the most ever after routing chip stocks yesterday. Huang's net worth slumped about $10 billion to $94.9 billion on Tuesday, the biggest single-day drop for him since the Bloomberg Billionaire Index began tracking his wealth in 2016. The plunge followed a 9.5% drop in the shares of the chip maker he co-founded. And that's your brief, John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the programme, the Morning Calls Plus, on holding co-CEOs Martin Hoffman and Mark Mora as the brand looks to continue gaining market share in the footwear space. We'll cross over to Lisa at the Goldman Sachs Retail Conference in just a moment. From New York this morning, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
1 hour and 16 minutes away from the cash open. Futures pulling back by 0.4%. Yields a little bit lower by a basis point. The 10-year 381.96. Time now for some morning calls. First up, TD Cowen upgrading Sweetgreen to a buy with a $43 price target. The analysts seeing strength this year, driving more upside in 2025 than consensus estimates. They've got to do better on portions. Terrible. The protein portions, you notice that? Like it's 4 bits of chicken.
A little bit of a scoop. Yeah, they need to up it up.
Figure it out. Sweetgreen up by 2%. That's probably why. Next up, Barclays downgrading Supermicro to equal weight with a $4.38 price target. The analysts taking a more cautious view following poor gross margin in the June quarter and an annual filing delay. The stock is down by another 2.9%. And finally, B of A double upgrading Nasdaq to buy from underperform with a $90 price target. The analysts forecasting a rebound in IPOs following the US presidential election, which will benefit the company's listing business. Nasdaq is up by about 1%. Let's head back to Lisa on the ground at the Goldman Sachs Global Retailing Conference with the consumer very much in focus this morning. Morning, Bramo.
Hey, good morning, John. Honestly, to me, the big question for everybody, I'm sure on Wall Street as well as here, is just what is the state of the U.S. consumer? The state of the U.S. consumer when it comes to running shoes, at least for On Holding, is very strong, at least from based on ongoing demand. But there's a real question here about market share and how do you grow a company this much with some 70% gain in the shares just this year alone at a time where the likes of Nike are seeing a decline of 24%. I'm so pleased to say joining us now are the co-CEOs and godfather of each other's children. We have Martin Hoffman as well as Mark Moorer. So I want to start with this question of how do you sort of establish yourself in the running category that's highly competitive, where you're also seeing declines elsewhere?
So the mission of the company is to igniting the human spirit through movement. And we started in running. We broke out into many other categories like tennis, like outdoors, training, but also lifestyle. And we want to be the most premium performance sportswear brand. And so we live at that intersection of performance and design. So we speak to a customer that wants to win a marathon. We speak to the everyday runner, but we also speak to the one who loves to move in the product. And I think growing in the premium category is really strong. And to your question on the consumer demand, I mean, we had an amazing summer. We had so many highlights from Paris to the launch with Zendaya. And we had over $1 billion in sales in the first half of the year with 30% growth. So we couldn't be happier with where we are.
So I could just say that, you know, Roger Federer joined with you, you know this, 2018, I believe, owning 3% of the company. You IPO'd in 2021, and it was kind of a slow start. What catalyzed the sort of surge that we've seen so far this year?
So I don't think we had a slow start. We grew consistently by 70% almost over the last couple of years, including the IPO. And I think since the IPO, we've been very focused on executing on our strategy, which was, you know, we wanted to increase the footprint that we had in the US. It was important to start to get into own retail. We wanted to grow apparel. It was important for us to continue to gain share in Asia and in China. And I think we've executed on all of these points. And we knew we need to transition from a phase of hyper growth into a phase of what we call more durable growth. So this is more in the 25 to 30% range. And I think this is exactly the journey we're on. This is what's happening this year. The nice thing is we're at the size now where that still means we're winning a lot of incremental new consumers, and we can give them access to On products, to On apparel, to On footwear. And I think we're quite happy since the IPO on the journey that we're on.
You're a Zurich-based company, but the bulk of the growth has been in the U.S. and in North and South America. How do you see that evolving over time? I mean, is that basically the biggest growth area going forward, or is really China the biggest growth area?
I mean, the US is our most important market, and we make about 65% of sales in the Americas region. At the same time, Asia is the fastest growing market, including China, Japan, Australia. So I think being born in Switzerland, we became a global company very early on. And this helps us because we have so many pillars of growth all around the world that we can execute on. And yeah, I think that's a unique position.
You know, I talked about Nike, and they kind of grew up in tandem with Michael Jordan and his star power. You not grew up, but you rode in tandem with Roger Federer. You have the Rogers in terms of shoes. Now you're bringing on Zendaya. She's not a sports star. What sort of does this represent about the shift in how you're trying to target specific influencers in a world that some people are saying the barrier to entry is not lower, but different in terms of potential disruptors based on social media, et cetera?
I mean, Martin said it in the very beginning, we're about igniting the human spirit through movement, right? And so for us, the question was, how can we credibly tap into many different communities and excite them to move? And Roger was absolutely essential to tap into the tennis community, to start to build tennis together, and also make the company known to more and more people, right? Because of obviously the awareness that he has and how he was helping On to reach a larger audience. And with Zendaya, we spotted her wearing the product. And she was wearing the product moving, you know, she wasn't wearing the product just standing around. And so a discussion started, and it was very important for her that more people can get access to movement and that she can shape a little bit the messaging that's happening there and the products that these people are wearing. So that really allowed us to start to work with her on apparel collections, on footwear collections. She's wearing the Cloud Tilt a lot. She has her own apparel line. We're going to see more of that. And so that allows her to bring now that collection to her community. And so On is very much about the end. And this is also what you saw in the air tennis video. Roger couldn't play air tennis by himself, nor could Zendaya do that. And for us to bring both, you know, characters together and individuals together is a huge dream, and we're very, very happy that we can bring that to the world.
How do you sort of see the strategy evolving? One thing that I've been talking with a lot of people this morning is this question around direct-to-consumer, which was, you know, a focus of Nike's, and I hate to keep mentioning them, but, you know, this is sort of the parallel that some people are drawing, and this need to do both, right? This idea to emphasize stores, but also direct-to-consumer, and also website. I mean, how do you sort of navigate that? How does that evolve based on where you are now?
Yeah, we absolutely believe in the power of the multi-channel distribution network. And we started with Run Specialty. They are still a super important partner for us. And because that combination of wholesale partners and our own direct-to-consumer channels, they allow us to reach much more customers in a shorter amount of time. And a few years ago, we started to build our own retail network with the first store here in New York. Now we have 25 stores outside of China, same amount in China. And that channel is performing incredibly well for us as well, and including super high apparel share, so very important on bringing apparel up as an important category for On. So we really see that this combination of the reach of wholesale partners and then being able to connect more closer with the customers through our D2C channels is a very important combination and success factor for On.
You talk about China. There's a lot of concern about what the landscape is going to look like for non-Chinese companies in the mainland, particularly as we don't really know where leadership is going and where the moods are going and where tariffs are going. I mean, how are you navigating that at a time where you're trying to expand?
Yeah, for us, it's about bringing the experience of movement to the consumer, right? And I think this is really what we're focused on. So we have a largely local team. So there's very few actually Swiss or Western people in China scaling the brand. We're focusing on building stores in China, touching the consumers through our digital channels. We're focusing on having the right product available, and it's working out. So we're growing very, very strongly in China. We're very happy. It's together with Japan, our fastest growing market. And I think, you know, the On story and what we've built in the other markets shows that in China, we're still very much behind on an adoption curve from a market penetration. And we still feel, hey, there's so much leeway to grow. And how consumer demand is exactly working out in China isn't even that important for us because we're still comparably small. And so I think we're quite positive on how we can look at the near future. And we're also very positive that we can navigate more political topics.
Who do you see as your biggest competitor right now?
I think if you look into our history, we have almost created the market that we are in today, so that premium performance sportswear market. And so I think for us, it's much more of opening up more market opportunities. Take our collaborations with Loewe, for example, where we also open up new price points for our brand. So we focus on ourselves, and really the core is in innovation. So in Paris, we announced Light Spray, which we think has the potential to really revolutionize the running industry, how a product looks, how a product is manufactured, and how you come up to the next level of sustainability. So we are focused on ourselves.
Do you guys go for runs in the morning together?
A lot.
Really?
Yeah, I mean, not so much together actually, because Martin is way faster now. Not so much together, but running and movement is a very important part of our culture. So I think it really helps us to move while we're thinking through problems, and I think it helps us to come up with better solutions. And it's not just us doing it, it's a big part of what the company is doing. And we also did a run this morning with many of the investors at 6 a.m. and so we're helping them to have a good start into the day.
Just real quick here, what's your sense going forward of what that biggest problem would be for this year as you think through it every morning in your runs?
I think the fun part really of our job is to be able to scale and to think about what's the right speed for the company, what do we need to do next to bring the company to the next level. You know, sometimes it still feels like we are acting in a 500 million company, but we want to be a 3.5 billion company. And that's the fun part. And this is also what we talk a lot with the team about. Embrace the challenge, embrace the uncertainty, and that everything is a little bit chaotic. But I think that makes up the fun.
Mark, Martin, thank you so much for being with us. Really appreciate it. And John, I have to say, as I was eating my bagel, came in this morning and saw them all, you know, gathered together after their run, and it felt very different. Anyway,
Lisa, are you trying to get invited on a run with the team at On?
Maybe. I don't know. It might have been better, but it was a little too late.
Lisa, looking forward to the coverage a little bit later. Lisa at the Goldman Sachs Global Retailing Conference, joining us again in about 20 minutes' time when she'll catch up with an executive from Walmart. Look out for that. Coming up next on this programme, we'll look ahead to the week ahead with payrolls on Friday. Stephanie Roth of Wolfe Research and Amanda Lynham of BlackRock still to come. And later, the Walmart Senior VP, Manish Joneja. From New York City, this is Bloomberg.
A lot's happening on Wall Street.
That couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the opening bell, equities pulling back by 0.4%. In the Nasdaq, we look like this. We're down by 0.7. On a Russell, we're down by 0.5. The pullback continues. It's almost like a repeat of a month ago. The nervousness started with the ISM manufacturing number, kicked in again yesterday. Look, we said this a little bit earlier. I don't think you can point to any one thing for a reason for the sell-off, the magnitude of the move lower that we got across the board yesterday on the S&P 500, on the Nasdaq, on elsewhere. But it continues this morning. If you switch on the board, you see it as well in the bond market. The rally continues in treasuries. Yields lower by almost a basis point at a 2-year. We give just a little bit of that up at 385.70. And in foreign exchange, just a classic risk-off move in yesterday's session. The only thing stronger against the dollar, the yen, and the Swissy. The yen stronger again this morning, 145 on dollar yen. We're negative by 0.2%. Under Savannah's this morning, some top stories for you. Nvidia suffering a record $279 billion rout, the biggest loss of value ever for a US stock, thanks to fresh worries over the AI frenzy. This, as the DOJ slaps the chip maker with an antitrust subpoena over its market dominance. So the pain for this name continues.
That's right. And this is actually a Bloomberg scoop yesterday, Jonathan. We know that the company was given a questionnaire, but now it's a subpoena. So basically, that sets up the showdown that the DOJ step closer to a formal complaint on NVIDIA. Their concern is basically they just have too much market share. But we talked to Mandeep Singh. Where else really are customers supposed to go?
Where can they go? What are the alternatives? That is why this name has been doing so well. We'll hear more about those complaints, no doubt, over the next several weeks or so. We'll hear more about this, too, on a campaign trail. This story, the standout one for us this morning. Nippon Steel saying it will appoint a majority American board if its takeover of US Steel is approved. The Japanese steel giant extending an olive branch to US lawmakers who have opposed the deal, including both presidential candidates Donald Trump and Kamala Harris. US Steel saying that if this does not go through, then they might have to shut plants and they might have to move out of Pittsburgh.
If that's the case, then is there going to be a new reaction from, say, Kamala Harris or Donald Trump? The debate is next week. It is going to be in Pennsylvania. And what does every single political analyst come on this show and say? That is going to be the end-all to be-all to this election. The Wall Street Journal editorial board this morning takes no qualms, is going after everyone on the right and the left, and says a politician with the U.S. national interest in mind would celebrate the Nippon Steel deal, which would boost U.S. manufacturing, which is basically what the CEO is saying. And he's saying, if I don't get this cash infusion, I'm going to have to close factories and I'm going to have to lose jobs.
How will they respond to that in a campaign trail in the next week? Especially, and you've said this repeatedly through this morning, Pennsylvania is a big, big state in this election, but it's also hosting the debate between Harris and Trump a week yesterday. Elsewhere, beyond the tech route, traders also keeping an eye on this week's US eco data, including JOLTS, jobless claims and August payroll. Stephanie Roth of Wolfe Research anticipated 175,000 jobs were added last month, and for unemployment to come in line at 4.2%. Stephanie, I'm pleased to say, is back with us. Stephanie, first of all, welcome back. Second of all, congratulations on your little baby girl. We're looking forward to more conversations with you in the future. So thanks for racing back for Payrolls Friday. We appreciate it. Let's talk about payrolls first, Stephanie. Let's get to it. Payrolls on Friday, the median estimate in our survey around 165,000. We've already heard from the Fed Chair, Chairman Powell in Jackson Hole, that he does not welcome any further deterioration in this jobs market. What is further calling further deterioration in this jobs market? How would we define that on Friday?
I think that would be another payrolls print that's sub 150,000. I think that would be the unemployment rate potentially rising up to 4.4%. Again, not our call, but if we continue to just see more signs of softness, our base case is that a lot of the softness that we saw in the month of July was driven by Hurricane Beryl. And we'll see a 37,000 rebound from the state of Texas, in which case our payrolls print will be above 150,000, which we kind of view as trend. So if we see a number closer to 100,000 this month, and we'll have to reassess our sort of view on the labor market. But our base case is the print should come in pretty solid.
Even if we get 150, given the revisions we saw over the previous year, why shouldn't I just chop off 60, 70,000 off that number on Friday?
Well, I think the revisions might be a little bit overstated, right? So we initially had the numbers that came in, and then it was revised down because of unemployment insurance records. And it's actually possible the revisions won't be quite as large once we get the final numbers, because immigration has been playing a role here, and it's possible that's not necessarily getting counted in the unemployment insurance. So basically, it's a lot of noise to say. I wouldn't necessarily chop off 60 to 70,000. Maybe you can chop off 30 to 40,000, but then you're still looking at a labor market that's still growing jobs and an economy that's doing okay. And by the way, consumer spending is growing about 3% in real terms.
Slowing, so not slow. I'd also love to get your take on what happened yesterday with the ISM manufacturing. We just had Andrew Hollenhorst published a report saying a fifth consecutive sub-50 ISM reading shows the manufacturing sector is in a sustained contraction. Do you foresee that through the end of the year?
The ISM has been weak for a long time. It hasn't been a great measure of what's happening in terms of the broad economy. And by the way, measures of sentiment, which is effectively what a PMI is, it's asking, purchasing managers, how are conditions this month versus last month? Same with consumer confidence. That would have told you we were in a recession for all of last year. So I wouldn't necessarily take that as an indication of where actual broad growth is for the economy. That said, the manufacturing sector has been hurt by elevated rates, and we've seen a cyclical slowdown in a lot of parts of rate-sensitive aspects of the economy. We might see that for the next quarter or so, but now that rates have come down, we should start to see a rebound in the manufacturing sector. I wouldn't necessarily anticipate that in Q3. I think Q4 and heading into next year, especially as we get certainty from a political perspective, I think there might be, and they mentioned this in the report yesterday, there might be some hesitation to invest just because we don't know what the political landscape will be, especially from a tax perspective. But our base case is Q4 into Q1, you'll start to see a rebound in the manufacturing sector, and the cyclical parts of the economy will start to pick up.
So basically, are parts of the economy just on hold until after November 5th?
I think that's fair. Well, at least on the cyclical side and the business investment side. There have been some questions about whether the consumers are waiting to see the result of the election. I don't think so. I think the consumer, and we certainly saw that with Q2 GDP, the consumer is continuing to spend in real terms. Certainly goods spending has picked up a little bit. Services spending has been fairly solid, albeit a little slower. But I think it's fair to say on the capital spending side, there are a lot of companies that are just in hold mode. And then once they see the results of the election, realistically, probably either way, they'll be able to start investing again. And they'll have a greater sense in terms of what the investing landscape will be next year.
Stephanie, we've got to leave it there. It's good to have you back. The brilliant Stephanie Roth of Wolfe Research on the latest on the jobs market, looking ahead to Friday and beyond. With us around the table, Amanda Lynham of BlackRock. Amanda, good morning to you. It's good to see you.
Thank you for having me.
Let's get to this credit market. How sensitive has this credit market been to the growth scare of the last 4 weeks?
It's been incredibly sensitive, and I think you can see it both in the widening that happened during the early part of August and the very swift snap back. And I think what that shows you is that the credit market is sensitive to the growth backdrop, especially high yield and leveraged loan issuers in the credit market, not just the cost of capital and the interest rate environment. Starting trading yesterday morning, we had retraced the entirety of the early August widening. We saw almost a record day of new issue supply yesterday in the corporate credit market, so spreads have gapped out a little bit wider than that. But we're still in this kind of narrow range. We're seeing widening get bought by investors. I think the key for credit investors is that, one, yes, the forward path of monetary policy matters, but the reasons behind that rate cut really matter. And then two, we don't need really strong growth in credit to remain resilient. We just need trend or slightly above trend. And I think there's really a wide chasm between a recessionary outcome and the current pace of above trend or slightly above trend growth. And we live in that space in between.
You noted the recent round trip. How symmetrical was the widening versus the tightening beneath the surface? What led and what lagged?
So actually, a kind of higher beta cyclical sectors led the tightening, but it wasn't uniform. For example, triple Cs are still underperforming the overall